Learning objective 2, analyze the impact of business transactions on the accounting equation. Okay, so the slides have a step-by-step illustration, which I'm going to use. In the classroom, I normally write these out up on an overhead. So what I've decided is I'm going to do similar thing, except I'm going to use a spreadsheet. And hopefully by me writing it out and explaining it while I'm writing it out or actually typing it, it'll help. It'll help in making more sense, okay? The example here is we're going to look at Alladin Travel Incorporated. This appears to be a travel agency, which is a service. And so we're going to go through the steps of a corporation and how economic events that Alladin Travel Incorporated is going to incur, how they're actually recorded in the books of the company, in the accounting system, but more importantly, their impact onto the accounting equation. The accounting equation is assets equal liabilities plus equity. Okay, so on April 1st, the beginning of April, Starr Williams and a few friends invest $50,000 to Open Travel Incorporated, and the business issues common stock to the stockholders. So this has to be looked upon definitely from the company's perspective, not from anybody else's perspective, but from the company's perspective. What you're recording are events that are associated with the company, the organization, and how it impacted their accounting system. When the company sells stock or issues stock, but in this case it's a sale of stock for $50,000, the company receives cash, all right? Now, as I mentioned to you earlier, stock is not a loan. When somebody gives money as an investor, there's no promise to pay that money back. It's an investment. So the shareholders invest in that corporation. The two accounts that are going to be impacted by this transaction are cash. And remember, we're talking about the company's cash. Somebody showed up on the front door and said, here's some money. The company takes the money and then gives them stock. Okay, the company takes the money. Now they have the cash and they issue stock to that shareholder. So the shareholder walks away and has shares. It's almost like a receipt, but shares that show that now they own shares or they own stock on that corporation, all right? So Starr Williams and a few friends invest $50,000 to open Alladin Travel Inc. Now, the fact that it's Starr Williams is irrelevant to us. It's Starr Williams and a few friends. It's investors to us. So from our perspective, from the business perspective, what do we get? We got cash, all right? So what we have here is under assets. Cash is an asset. It's a resource that has future value, and we're increasing it by $50,000. Okay, so I'm going to go ahead and move this over here so that we can actually do this together, just like if I were doing it. All right, so I'm going to create an account called cash. It's going to sit under assets, the account cash. It's under the broad category of assets. And I guess, am I going to give this a date? I'll just call it number 1, transaction number 1. Yeah, we'll refer to it as number 1. So number 1. So we had a positive. It's a positive number, $50,000, and this is an increase to cash. And this is what I want you to kind of get used to, is talking about cash and any transaction as to whether it increases or decreases the specific account. In this case, there was no cash in our bank account until this money showed up. So for transaction number 1, cash is increased. That's a positive amount. Now, in addition to that, we are keeping track of how much stock that's issued, how much in common stock has been issued. We call it common stock, or yeah, common stock. So and common stock is an account that sits under the equity section of the accounting equation. Assets equal liabilities plus equity. So we're going to put here common stock, and we're going to put $50,000. Now, Recognize that this is one transaction that impacted two accounts. Cash was increased by 50,000. Common stock was increased by 50,000. Now the accounting equation says assets equal liabilities plus equity. Well, just a spot check. How much in assets do we have? Well, so far, $50,000. That's what we have in assets so far, right? Cash. That's all we have in assets. Do we have any liabilities? No, no liabilities. So that's zero. Do we have equities? Yep, we have $50,000 in equity. You guys follow? Okay, so if we have $50,000 in equity, then let's check to make sure that the accounting equation is still holding. Assets equal liabilities plus equity. 50,000 in assets equal 0 plus 50. Boom, it's working. 50,000 and 50,000. Assets equal liabilities plus equity. So we have just witnessed how the first transaction impacts the accounting equation. Now here we have an explanation as to what has occurred with the stockholders' equity, and that explanation, I'll just leave it here because this is what you're walking away with. Issued common stock. Let's go to transaction number 2. So whether it's that day or the next day or a week from them is almost irrelevant. What happened? Something happened. An economic event occurred. What did happen is Alladin purchases land for a new location and pays cash of $40,000. Okay? So Alladin is going to give up some cash, but it's going to buy some land. Now, land is a resource, and that resource has future value. So guess what? Land is an asset. Okay? Land is an asset. So the way this is going to work is we're giving up some cash. Transaction number 2, we're going to give up some cash. How much? $40,000. What are we getting? We're getting land. Now, we're going to keep a total on what we have. How much cash do we have after that transaction occurs? Well, let's keep track. We started with 50,000 that came in, and then we gave up, after transaction 2, we gave up 40. So our balance, let's put a B here for balance, is now $10,000 of cash. Well, what do we have for land? We have $40,000 of land. So guess what? Total assets? Total assets is the sum of all the assets, $50,000. So in transaction 2, there was no impact to any liability because we don't owe any money. There was no impact to equity. Equity, there wasn't any stock issued. There weren't any dividends paid. There wasn't any revenue, and there weren't any expenses. So therefore, what we did in this transaction, in transaction number 2, is we traded an asset for an asset. We gave up cash, and we ended up with land. And we were going to record the land at what we paid for it. So our balance now for cash is 10, our land is 40, our total assets are 50. By the way, no impact on these liabilities or equities, so therefore, assets still equal liabilities plus equity. Transaction number 3, the business buys supplies on account, agreeing to pay $3,700 within 30 days. So the business is going to be buying supplies so that it can use those supplies to make money. But it didn't want to give up any cash. So it's agreeing to pay $3,700 within 30 days. So within 30 days is a clue now. Within 30 days means that we're likely going to classify this as something that's going to be paid sooner rather than later. There's not a long-term note. This isn't payment for a house or a mortgage or a vehicle over a long period of time. It's just something that's going to be paid in 30 days. When that occurs, we end up creating what's called accounts payable. So looks like we took supplies, that's one account. And because we're agreeing to pay this in 30 days, we're classifying this as accounts payable. Two accounts impacted, supplies and accounts payable. Now, supplies, what is that? Well, that is an asset. Why? Because it's a resource that has future value. If we use those supplies over a long period of time, if we buy supplies and they're used over an extended period of time, then we're going to consider them to be an asset. Don't get confused if you work for companies. Some companies might just go ahead and consider them to be an expense immediately. But in this case, for Alladin Travel, their supplies are large enough for them to consider it an asset. So they paid $3,700, and now they have a liability of $37,000. So I'll go ahead and show you how that's going to be. So as an asset, we're going to create an account called supplies. Okay. And as a liability, we're going to create an account called accounts payable. And this is transaction number 3. So supplies is going to be, it says that they bought it for $3,700. So therefore, supplies is going to increase by $3,700. And accounts payable is going to increase by $3,700. Oops, yeah, $3,700. All right, so let's go ahead and get a balance for each of the 3 accounts that we have. Our cash balance is still $10,000 because we haven't given up any cash. We bought some supplies, but we didn't pay cash for it. We promised to pay in the future, so the supplies kicks up. And we still have the land. The land is still at $40,000. If we add total asset or cash plus supplies and land, our total assets are $53,700. Now, something new that we hadn't had before, now we have a liability. The liability is $3,700. That account is accounts payable. It is a liability. So we're going to keep track of our total liabilities. There's only one right now, so the total amount is $3,700. And our equity, well, so far just one account for $50,000, that's $50,000. So the accounting equation says assets equal liabilities plus equity. Well, total assets are $53,700 made up of cash, supplies, and land. Liabilities at this point in time, $3,700 in total, and equity, $50,000 in total. So $50,000 plus $3,700 is $53,700. There you go. That equals exactly the assets. Assets equal liabilities plus equity. Transaction number 4. Alladin earns $7,000 of service revenue by providing services for customers. The transaction 4 should be a little bit more clear because they say Alladin earns, but in this case, they should have made it a little bit more clear because it could have been this way or not, but let me make it more specific. Alladin receives $7,000 of cash for services rendered, and they provided service for the customer. $7,000 of cash received. So Alladin is a travel agency. They booked a few hotels, vacations for a number of people. And on that day, they received cash. Now, when I say cash, it could be in the form of a check. It could be in the form of a credit card or debit card. But they received the money so that once the money is received, it goes into their cash accounts. All right, so let's see how that's recorded. Well, transaction number 4. $7,000 was received in cash. That's going to be a positive impact to cash. $7,000 service revenue by providing services for customers. That's a positive impact to cash. That increases cash by $7,000. Now, in addition to that, remember there's always minimum of 2 accounts impacted. In addition to that, Alladin is going to recognize its first revenue amount. Now, revenues, as we discussed earlier, are a part of equity. So we're still here on transaction number 4. $7,000 goes here under revenues. Now, if we want to go ahead and, okay. So what we're going to do is create an account called retained earnings. And retained earnings is made up of, we've talked about this already. Retained earnings is made up of revenues and expenses, okay? So $7,000, we're gonna really categorize that under a specific account revenue, but revenue sits under the broader category of retained earnings. So revenue is retained earnings. Might even be service revenue, is that what it is? Yeah, service revenue. Let's do it like they do it, so it's not as confusing. So service revenue. All right, now we're gonna add up, now we're gonna give the total balances here for equity as well. So we know common stock equals 50,000 and service revenue, and retained earnings equals $7,000. The balance cash is 17, supplies is still 37, land is 40. We add this across and we end up with $60,700. Accounts payable is $3,700. Okay, so we plug that in. 50,000 is common stock, and retained earnings now is 7,000. So retained earnings is a part of equity, so we need to modify this formula and make sure we've added this up. So our total equity now, this is our equity section, our total equity is 57. So let's take that 57,000, we're going to add $3,700. That's going to leave us $60,700. Liabilities plus equity equals $60,700. Oh my goodness, total assets equal to $60,700. Perfect. We got it. Assets equal liabilities plus equity. We've already done 4 transactions and we're seeing how this all works. Transaction number 5. Alladin performs services on account, which means that Alladin lets some customers pay later. So in the first example, we sold services, but we sold it for cash. That's why I was saying earlier that they needed to be a little bit more clear that the cash came in. But in this case, they make it very clear that it was services on account. On account means you could pay us later, all right? So there's 2 accounts that are going to be impacted by this transaction. One of them is going to be similar to when we sold it before. When we sold it for cash, we debited the cash and we credited retained earnings, but specifically service revenue. Well, guess what? Service revenue, we still sold it. It's sold. It's the same thing. It's just we've decided that we don't necessarily need the cash right now, or we're not selling it for cash right now. They promised to pay us within a certain period of time, probably within 30 days. So we're going to actually recognize the same revenue, service revenue. Okay, so service revenue is $3,000. That's going to increase revenue. By the way, increasing revenue means we increase retained earnings. In addition to that, we're going to go ahead and create an account here called accounts receivable. And accounts receivable is an account that represents money that we expect to come in after we've sold something. So when we sell something on account, we recognize it as an accounts receivable. So now we have $3,000 increase to accounts receivable, a $3,000 increase to retained earnings, specifically service revenue. And that's transaction number 5. Now, is our accounting equation still holding? Total cash, $17,000. Total accounts receivable, $3,000. Total supplies, $3,700. Total land, $40,000. The sum of all those numbers, total assets are $63,700. Total liabilities, no change, $3,700. Total equity, that did change, that's at $60,000. 50 plus the 10, total 60. So let's add these 2 up. $63,700, liabilities plus equity, equal total assets. We are good to go. We are in balance. Moving on to transaction number 6. During the month, Alladin Travel Incorporated pays $2,700 for the following expenses. Rent, $1,100. Employee salary, $1,200. And utilities, $400. Okay, so we can if we want to double check this, we'll add these up real quick. 1100 plus 1200, that gives us 2300. And then let's add another 400, that's 2700. So these three numbers total up, these total expenses equal the cash we gave out. So we're giving something up. We're giving something up. We gave up some cash, but in this case, we're not walking away with anything, but we do have to pay rent. Well, that's not true. When we pay rent, we do walk away with a building for a limited amount of time. For the employees, well, we had them working for us for a limited amount of time. And for utilities, we got the benefit of utilities. We call those expenses, though, because once they're paid, there's really no future value. And I'll give you the example. If I have a utility bill that I spend $400 on, can I turn around and sell that utility bill to somebody else? Well, let me ask you this. Would you buy it from me? Would you buy my utility bill? And if you would, I want you to go ahead and send me an email and say, hey, please send me your utility bill. I'd be happy to pay for it. And tell me what you're willing to pay. Chances are you're not going to send me an email, so I'm not going to hold my breath. But the utilities were necessary in order for me to generate revenues. I had to pay rent. I had to pay utilities, and I had to pay my employees in order to generate the money that we generated. So I paid $1,100, $1,200 in utilities, $400. Think of it, well, not think of it. The definition of expenses is a cost that has no future value. It's almost not almost. It is the opposite of the asset. When we buy supplies, that has future value, so we categorized it as an asset. When we bought land that has future value, we categorize it as an asset. When we pay for rent, employee salaries, and utilities, those aren't assets. Those are expenses. Those are costs that have no future value because I can't sell you a utility bill. I can't sell you for something that I've already used up. I can't sell you the work my employee did for me last week. I can't sell you that. Okay? So I have 1,100 plus 1,200 plus 400. The total is 27. So I'm giving up $2,700. So let's go ahead. That's number six. Okay, so number 6. Okay, so the first thing I'm going to do is reduce my cash. I'm giving up $2,700. So for transaction 6, I will show a negative $2,700. In addition to that, I'm going to reduce my retained earnings by, well, the first thing is $1,100. And that's going to be rent expense. In addition to that, I'm giving up $1,200, and that's salaries expense. So I'm losing earnings here because these are expenses. I'm losing earnings. I'm reducing my earnings. I'm reducing my retained earnings. So that's a salary expense. And then the last thing is $400 for utilities. So I'm subtracting $400, and that's going against utilities expense. So now let's make sure that our accounting equation is still holding. Right now, my total assets, $61,000. Total liabilities, those haven't changed at all, $3,700. My total equity is $57,300. So we're going to add $57,300 to $3,700. And if you want to double check it, you should, but that means that this plus this is equal to $61,000. So assets equal liabilities plus equity. Moving on to transaction number 7. I'm going to go ahead and put it down here because we took up all those rows. So what occurred for transaction number 7? Alladin pays $1,900 on account, which means to make a payment toward an accounts payable. So remember, back in the day, let's go back and look. Transaction, there's $3,700. When was it? Well, it was transaction number 3. Remember this? We bought the supplies on account whenever it happened, it happened. Now the company is ready to make a payment. And they're going to pay, of that total $3,700, they're going to pay $1,900. They're going to give up $1,900. So what impact does that have on the equation? So we're going to subtract $1,900 of cash. And then, because we paid some of it off, we can actually reduce or subtract $1,900 from the liability. We don't owe $37 anymore. We owe less than that. We owe $1,900 less. Our new accounts payable balance after that payment is now $1,800. So 18 plus 57,300 is equal to 59,100. Assets still equal liabilities plus equity. Okay, so that's transaction 7. Let's move on to transaction 8. Starr Williams, the major stockholder of Alladin Travel, paid $30,000 out of her personal bank account to remodel her home. Well, this is an investor who uses their own money to do something for themselves. Well, this is what we mean by separate economic entity. The business is the business and the owners are the owners. The owners may have personal expenses and they may pay it out of their own personal bank accounts, but that has nothing to do with the bank account of the business, okay? So therefore, when we have that kind of a situation, the question becomes, do we even have a journal entry or do we have a transaction that needs to be recorded? And the answer is no, we do not. There's no entry. Transaction number 9. Back in transaction number 5, Alladin performed services for customers on account. The business now collects $1,000 from a customer. So we didn't get it all, but we got a good chunk of it. So what do we, this was number 8, no entry. Let's go to number 9. And number 9 says, oops, we got $1,000 arrived. It arrived today, $1,000. Boom, we deposited into our bank accounts. We are happy. Now, where did it come from? Well, it came from accounts receivable. So our balance for accounts receivable is $3,000, but we got $1,000. So nobody owes us $3,000 anymore. They don't owe it. We collected $1,000. So what's remaining? They only owe us $1,000. So we reduced our accounts receivable by $1,000. So we increased cash for $1,000 and we subtracted from accounts receivable $1,000. That means that the net effect to assets is 0. We increased cash and decreased accounts receivable. The overall impact to assets is nothing. There was no impact to accounts payable and no impact to equity. We are still in balance. That's transaction number 9. Transaction number 10, Alladin sells some land for $22,000, which is the same amount Alladin paid for the land. Transaction 10. So let's go ahead and put 10 here. I guess we didn't need all the land, so we sold some of it. We sold it for $10,000. That means we got cash of $10,000. That's awesome. We got $10,000, but now we don't owe all this land. Is that what we sold it for 10? No, $22,000. Sorry, I don't know where I got to. So $22,000 is what we sold it for. So we got some cash, but we gave up land. We don't owe all the land anymore. We gave up exactly what we paid for it, which is the way it's described. $22,000 was given up. So this is the same kind of a situation where cash went up by 22, land went down by 22. The net effect to overall assets, no effect. We just traded an asset for an asset here, okay? 2 accounts were impacted, but both of them were assets. One increased, one decreased. No impact on any liabilities and no impact to equity. Number 10, number 11, Alladin Travel Incorporated declares a dividend and pays the stockholders $2,100. So Alladin Travel Incorporated has made a determination that they have made some money, and now they're ready to pay some of that money out to the shareholders in the form of dividends, specifically $2,100. Okay, so this is 11. What does that mean? Well, we're going to decrease our cash amount. We're going to subtract it. How much? $2,100. And dividends are paid out of retained earnings. Now, just so that we're clear, dividends is not an expense. It's not an operational expense. Never consider dividends an expense. However, it does reduce retained earnings, similar to the way expenses reduce retained earnings. So we account for them in a similar manner. They are a reduction of retained earnings. However, you will not see dividends expense on an income statement because that's not. It's a return. It's sharing a part of the net income of the corporation with the shareholders, not an expense. It's money they made. They said, okay, we made some money, so here's some. I think that might be the last transaction. Yep. So this is what I drew up. I just did it step by step, but I drew up assets, liabilities plus stockholders' equity. And here you have all the transactions that have occurred under cash, accounts receivable, supplies, land, AP, common stock, retained earnings, and those are the impact. The bottom line balances are $57,000 for both assets and liabilities and equity, which is what I had here. And one thing I could do is just add both the liability and equity, and that comes up with 57. So that's why we have 57 here and 57 here. From the information that has been, by the way, this is the accounting system. This is the books. I mean, it's a pretty simple set of books because we only have 1, 2, 3, 4, 5, 6, 7 accounts, right? Actually, 7, 8, 9, 10, 11. So there's 11 accounts here. But we could take what's been listed here and generate financial statements from that information. So the question is, well, what's the first financial statement is the income statement, right? So let's do that. Alladin Travel Inc. income statement for the month ended April 30th, 2018. So this company was started in 2018, in April of 2018. So first thing we're going to do is recognize service revenue. And we're going to add 7 plus 3 is 10,000. Let's go back. Revenues, 7 plus 3, 10,000. So that's income. So that's income to the company. That's money that is coming in or has come in. Now, to get our income statement, we take our revenues and we subtract expenses. Well, we had 1, 2, 3 expenses. Those expenses, let's go back and look at them there. Rent expense, salary expense, and utility expense, and those are the dollar amounts he just carried right over. So $1,200, $1,100, and $400. We're going to add all these expenses. Our total expenses were $2,700. We'll take our revenues, and we're going to subtract total expenses. Our net income for this period is $7,300. That's our income. So that's how it's going to be reported on the income statement. Note that under expenses, you do not see dividends. You don't include dividends here. They're going to be here in the next statement, but they're not here on the income statement. Just remember that. The next financial statement is the statement of retained earnings for the same period. Well, we have a retained earnings beginning April 1st, 2018. Well, this was a brand new company. They didn't even have any retained earnings. So start off as 0. We're going to add any net income or subtract any losses for the month. Well, we have net income. We know that because the income statement said so. $7,300 is going to carry over as net income to the statement of retained earnings. So the subtotal that we're going to have is $7,300. Now we're going to subtract the dividends. So I told you the dividends Dividends are never an expense, but they are a reduction of retained earnings. So we're going to show this as a reduction, not as an expense on the income statement, but on the statement of retained earnings as a reduction, less dividends declared on the statement of retained earnings. So less 2,100 leaves us retained earning balance as of April 30th, 2018 of $5,200. If we go back to our spreadsheet, we'll see that $5,200 is listed under retained earnings. All right, and then finally we have our balance sheet. So we just scooted up the statement of retained earnings. It was here, and now in the next slide it's slid up here. Now we're going to work on the balance sheet. And the balance sheet is a listing of all the assets, liabilities, and stockholders' equity. So assets, well, cash, $33,300. Where did that come from? Let's go to our spreadsheet. Cash, $33,300. You see that? Just carried right over. I bet you we're going to see AR at $2,000. Let's go see. Accounts receivable, $2,000. Supplies, if you go back and look at that spreadsheet, $3,700. Land, $18,000. It's all on the spreadsheet. You can look at it. It's there. We're going to add these all up. That's $57,000, which is what we did on the spreadsheet as well. We added up our assets. $57,000. We are good to go. Liabilities. Let's go back to the spreadsheet. $1,800. Accounts payable. 18. That's the balance. $1,800. That's what carries over to the balance sheet. $1,800. And then the stockholders' equity shows common stock, $50,000. That's what we had on the spreadsheet. Common stock, $50,000. And then retained earnings, well, we figured this out already. We figured it out on the previous statement of retained earnings. This $5,200 carries right here. So we're going to add our 50 plus the 5,200. That gives us 55,200. Our total stockholders' equity is 55,200. Now, on the balance sheet, we're going to go ahead and add accounts payable plus, well, we're going to add total liabilities plus total stockholders' equity, and that gives us total liabilities and stockholders' equity of $57,000. Assets equal liabilities plus equity. Bingo. It all works out.